Hi, I'm Peter Pritchard with Animas Mountain Mortgage, and I've been lending in the entire state of Colorado for over 25 years. Buydowns, interest rate buydowns, have been a recent topic of conversation among local realtors and home buyers alike. So in an effort to help answer a lot of questions, here is a breakdown of the two types of buydowns. There's permanent and temporary buydowns. A permanent buydown is where you pay a fee today to have a lower interest rate for the life of your loan. Historically, the interest rate is reduced by 0.25% with a 1% upfront fee. Sometimes the amount of the buydown can vary depending on the current interest rate yield curve, but assuming the 0.25% buydown is the current scenario, it's a simple math problem to decide if it makes sense for you or not. If your loan amount is $500,000 and you buy down the interest rate from 6.625 with a principal and interest payment of $3,201 to 6.375, so down by 0.25 point, with a P&I of $3,119, then you would save $82.20 per month. So it would cost you the 1% or $5,000 to save $82.20 per month, which would take 60 months or just over 5 years to recoup. So the question becomes, will you still be in the home after 5 years? Oftentimes it's an easy decision. People are temporarily buying the home, they're going to live there for a couple years, maybe fix it up and turn it around and sell because they're really not going to be in the area that long. There's lots of different scenarios I've heard over the years, but basically that's the question is, are you going to be there for 5 years or longer? Are you going to be in this loan for 5 years or longer? The average life of a loan is 6 to 7 years, and so whether you think so or not, the odds are that you're going to either refinance or sell and move somewhere else within 6 to 7 years. In this case, you would break even, you'd actually make a little bit of money, but in some cases the break-even period is your plan is to do something sooner than that and less than 5 years, and then you'd lose money by paying the point. So if this were me, I would take the organic interest rate, I'd save the $5,000 and use that to refinance in the event that interest rates go lower and get a permanent lower interest rate by a refinance down the road. And I have different videos on refinancing as well. And that's a better scenario for you as opposed to a buy down. Now, the scenario changes though if the buy down can be larger. So in some scenarios, you can pay a point in fee to get a 0.5 point in buy down in rate. That's different. So instead of 60 months, it might be 30 months or 24 months, somewhere in there. And then the question is pretty easy to answer. If you're going to be in that loan for longer than 2 years, 2.5 years, then you're in great shape. So you should do the buy down. So those are the kind of questions you want to ask when you're looking at permanent buydowns. A temporary buydown comes in the form of a 3-2-1 or a 2-1 or just a 1 buydown. Basically, the first number represents the reduction in payment as though the interest rate was reduced by that number for the first year. The second number represents the reduction in payment as though the interest rate were reduced by that number for the second year, and so on. So for this example, if you have a loan of $500,000 and an interest rate of 7%, you do a 2-1 buydown, the actual payment is $3,326, but the first year the payment would be hypothetically 2% lower, so $2,684. And then the second year, the payment would be hypothetically 1% lower, which would be $2,997 for the second year. And then from the third year and on, you'd be at the full payment of $3,326 for the remainder of the term of your loan. The cost of that buydown would be $11,653, or the monthly difference of the buydown amount versus the actual monthly payment for that 2-year period of time. So basically, on these temporary buydowns, what you're really doing is just taking that upfront amount of money, giving it to the lender, and having them hold it on your behalf and make those differences in the payments for the first year and the second year, so you don't have to worry about it. So the rationale for getting a temporary buydown is usually based on interest rates being high and the hopes that interest rates will be lower and you can refinance into a lower rate. And the question that I would pose in that scenario is, are you going to be able to afford the home if rates don't go down? What if they don't go down? What if they go higher and you're stuck in that interest rate and you can't make that payment? You'd be in a really bad situation if that were the case. So just want to make sure you're okay with that. In another line of thinking, maybe you have an auto loan and it'll be paid in full in 2 years. It's $700 a month in payment, so once that's gone, you'll be able to afford the full payment. That scenario is valid as well. The question is, or just the purpose of this video is to say that you want to do the math, you want to understand the scenario and the situation that you're putting yourself in when you choose one of these products. I hope this helps with your decision making the next time you purchase a home and you need a loan, and if you're questioning a permanent or a temporary buy down. If you have any questions, just feel free to DM me and I'll get back with any information I can. And otherwise, this is Peter Pritchard at Animas Mountain Mortgage. Thank you.